We recently published our asset class spotlight on global equity funds, and one of the topics we discussed was their exposure to emerging markets. Although the leeway for managers to invest in emerging market stocks is generally limited, global equity funds have a higher economic exposure to this region than their direct investments would indicate. In order to demonstrate this, we analyzed 112 actively managed open-end, closed-end and passively managed ETFs that carry a Morningstar analyst rating and reported investment portfolios in Morningstar Direct as of the end of March. So for most of the funds in this sample, they invest directly in emerging markets, but often at the margin. The median allocation to the region as per the end of March was 3.3%, and there were 21 funds in the sample that had no direct exposure to emerging markets at all. So analyzing direct emerging market exposures of global equity funds indicate that the allocation to the region is typically limited. However, traditional methodologies that classify a stock as belonging to a particular country or region do not always give the full picture. This is because traditional classification methods often categorize companies based on where the stock is listed, where the company was founded, or where its headquarters are based. So this approach does not necessarily reveal the underlying economic exposure of a company to a particular country or region, which is more relevant from an investor point of view. So with the increasingly globalized marketplace, firms have become less dependent on their home country, developing instead a global footprint and operating across multiple countries and regions. So to better capture portfolio exposure to multiple regions, we use the Morningstar Global Risk Model to estimate the partial economic exposure of each portfolio to 7 regional Morningstar benchmarks using regression techniques. So using the risk model measure of regional exposures gives a more accurate representation of the sensitivity of investments to emerging markets. So running the risk model to analyze the economic exposure of global equity funds to the 7 Morningstar regions reveals some interesting results and leads to different conclusions compared to the traditional classification methodology. As per the end of March, the risk model estimates that all global equity funds in our sample had some economic exposure to emerging markets. Even more striking, the median exposure to developing countries was 8.9%, so almost triple the exposure calculated under the traditional methodology. For funds that had no exposure to developing countries when using the traditional classification, the risk model actually estimates a median economic exposure of 4.7%. So this chart summarizes our findings on the emerging market exposure of global equity funds. So the bars represent the number of funds that fall within a certain emerging market exposure bucket under both the traditional risk and risk model framework. So under the traditional framework, 21 funds had no direct exposure to emerging markets, but when using the risk model, they all have some exposure. So that's why there's no bar for the risk model in the 0% bucket. Instead, the risk model indicates that global equity funds have a much stronger economic emerging market exposure, which causes the skew to the right when using the risk model framework to measure emerging market exposure. So investors should keep this in mind when considering investments to get a better sense of risk and return opportunities in an increasingly globalized marketplace.